Hello, everyone, and welcome to Tips Tuesday. I'm Brian Carlson, partner and senior consultant here at Fiducient Advisors. Today's tip is going to focus on cash balance pension plans. Now, pension plans have evolved throughout the years to use cash balance features in a variety of different ways. Most commonly, they would amend a traditional plan to add a cash balance component in an attempt to reduce some of the volatility of future benefits. Today, though, we'll be talking about using a cash balance plan as a standalone design, which is mostly benefit and being used by professional service firms, such as doctors groups or medical practices, law firms, asset management, or accounting and consulting firms. But it really could be used by any firm that has owner or equity partnership as its structure. So these cash balance plans are qualified ERISA plans, and their main benefit is they offer an enhanced opportunity for the firm to increase your tax deferred income. Now, it mainly benefits some of the owners and partners, but you could also see an advent and a benefit to all employees through increased match and or profit sharing to pass testing. Now, there are two main components, one of which is a contribution credit and the other is an interest credit, or think about that as an earnings credit. Here's some background on how the interest credit has evolved throughout the years. The first versions of these plans included an interest credit that was tied either to a fixed rate or a treasury rate. These plans work nicely to know a little bit more certainty about how the contributions were going to grow throughout the years. Say, for instance, a fixed rate that's going to grow at 5% each year, or if it's something like to treasury rates, such as a 10-year treasury, that's something that's readily available and known. But one of the drawbacks is the funding status, especially as these plans grew in assets and the volatility around those. Now, there are no assets that sync perfectly or align to earning 5% exactly every year. So you bring on some volatility there of how much you're earning versus how much you're crediting. And then on the treasury side, you have an inverse relationship of how rates move and how you credit those versus how you invest those. So for instance, over the last couple of years or 18 months, as interest rates has gone from the 2 to 3% range to 4 to 5%, your crediting rate goes up. So that's good. But if you're investing those assets in treasuries, those are going down. So you have a mismatch there. So one of the solves over the last decade or so has been the introduction of market rate or actual rate of return crediting rate designs. So by aligning the crediting rate to equal more of the actual return of your assets, it does remove some of the volatility around the asset returns and crediting rates. So for instance, if you earn 2% one year, your crediting rate is 2%. If you earn 6% one year, your crediting rate is 6%. Now, this is not perfect, because these plans are designed with a 0% cumulative floor. So if you earn -5 or -10%, you do have to make up that difference over the lifetime of the plan. But it does remove a lot of the interim year mismatch, or at least reduce some of that in negative years. When structured properly, these plans can provide the ability for partners to contribute or tax defer income more than $250,000 on an annual basis. Now, there is lifetime maxes. It's a little bit over $3 million, but still, that's a lot of excess tax deferred income over the lifetimes of these plans. Now, there are many unique features to be aware of when designing these plans. If you'd like to learn more about these and check out our additional resources, please visit our website at fiducientadvisors.com. Thanks for checking in today, and make sure to check out our Tips Tuesdays going forward. Thank you very much.